Hey traders, I've brought you my special gold strategy today. In this video, I'll show you exactly how to pull money out of the market in just one day. So stay connected with me till the end, my friends. In the market, when you're trading for one day, the first thing you must check is the market trend. You need to identify whether the market is moving in an uptrend, a downtrend, or a sideways range. Always notice the trend first before making any move. Once you've confirmed the trend, you need to analyze the market on the 15-minute and 1-hour charts. On these time frames, you'll clearly see whether gold is trending or consolidating. Here, you can see that gold made a higher high, and from this zone it has broken out. From here to this point, this stick or move has been completed. Now, gold has made another breakout, so the next target is the top of this previous stick. Once you've marked your levels, the next step begins. Remember, one-day trading is considered a short-term swing trade, which can last 1, 2, or 3 days maximum. But since our goal is to trade within one day, we'll focus on 4-hour and 1-hour analysis and then move down to the 15-minute chart. On the 15-minute chart, you need to apply the RSI indicator. From the RSI's oversold zone, check if gold has formed a bullish candle. Once you find that setup, drop down to the 1-minute chart for your exact entry. Your entry must happen on the 1-minute chart. Wait for a strong bullish candle to form. Don't enter before that. As soon as you see that candle appear, take your entry. Then place your stop loss below the candle's low. If the market reverses, you'll take a small loss and exit safely, protecting your capital. That's risk management. If the market continues in your direction, you'll stay in the trade. According to the market structure and law, when analysis is done properly, the market usually completes its target. However, if a big whale or an institutional bank suddenly sells, the market can change its behavior, switching from an uptrend to a downtrend. That's why you must always place a stop loss and trail it as the market moves. When the market follows its pattern and moves toward your target, measure from your entry to the top of the move to calculate your potential profit. If you're aiming for one-day profit, your target will be within this zone. But if you're swing trading for 2 or 3 days, your target may extend higher. However, never set your take profit exactly on a line. Treat the entire resistance zone as your target area. When the market reaches this resistance zone, check your 1-minute chart again. If you see a reversal candle, exit immediately. If the market creates a new higher low and continues up, move your stop loss to that new low, locking in profit so you don't go into loss. This is a powerful strategy. It gives you a precise entry point and keeps your capital safe. So take your entry when the conditions match, manage your stop loss wisely, and book your profits confidently. If you found this helpful, don't forget to like, subscribe, and comment below. Tell me what topic you'd like to see next, and I'll make my next video exactly on that. I upload 3 videos every day where I share technical analysis, signals, and market updates. Stay connected with me, trade wisely, and may your profits grow.